All right, everybody. Well, what another interesting weekend. It never is dull moment these days. It was Saturday, I remember. I don't know where I was, but I remember getting some on my phone going, oh, we just dropped a bunch of bombs on Iran. And then quickly I started thinking about, wow, I'm going to have to create some content around this. So here I go with this brief this week. My topic is really going to be about war and interest rates, and just kind of look back on some other types of war conflicts we've been in, what's happened to interest rates, also what is different about today than past. Guess what? I ultimately don't know what the hell interest rates will do because nobody knows, but we could do our best to break it down. We can look at this stuff. What else is going on that would affect interest rates? Is this more of a push down for lower rates, or this more because now we're in this uncertainty? Is it going to be more pushing rates up? So anyways, we're going to jump into it now and see what you think. And I wonder, when I bring up some of these conflicts, whether it's war or conflicts, you're going to go, oh my gosh, I forgot about that. And maybe you're a kid, maybe you're younger like I was, and some of the interest rates, what happened to rates, where they're at. It's pretty fascinating information when I was looking at it. So anyways, we'll jump into it, this video. And before we jump into this information and all this exciting news about interest rates, if we've never met, my name is Kenny Simpson. I focus on 1-4 unit financing. I've been doing it 20 years, helped over 5,000 clients, funded billions of dollars of loans. And whether you're a first-time home buyer, real estate investor, self-employed, I am a mortgage guru. No, I cannot fix your car, cannot build your house, cannot even fix your laptop. I'm not a very good handyman. I just understand the real estate market, the data, and I really know mortgages really well. And so nice to meet you. And I shoot videos like this because I want to help educate you. And by the way, it's not just me on the team. It's called the Simpson team. I have a whole team behind me, whether it's processors, underwriters, loan officer assistants, or my marketing team. We are here to help. And if I could help you, please reach out, call me, text me, schedule a call. You can find me online, Kenny Simpson Mortgage. I promise you, I will come up on Google, and it's not hard to get a hold of me because there's so much stuff and content out there that it's pretty hard to not find me. So anyways, thanks for watching. I'm excited to jump into this video because just looking at the data and information, what I gathered from back in the day of what happened is pretty fascinating to learn more about it. So going back to this data, was World War II in the 1940s? Yes. Kenny, why are we going back? Because I just wanted to see what happened to interest rates during that time. So if I look over here at the screen, I apologize, but I am going to have to read because there's no way I'm going to memorize all this stuff. So World War II, 1940s, interest rates were very low. The Fed capped long-term treasuries around 2.5%. That means they used the money to cap them to help the government borrow affordably. Mortgage rates stayed low and stable. Why? The government wanted to control costs for spending, and the Fed cooperated. Why? Because the government wanted to control costs for spending for the war, and the Fed cooperated, so they wanted to keep rates down. Vietnam War from 1960 to 1970s. Early years, rates started rising slowly. Late 1970s, inflation took off. War plus Great Society problems plus oil crisis equals runaway prices. That was a crazy time for inflation. If you never looked at time, go back and study it. Mortgage rates shot up by the late 70s. Ready, guys? Because if you think rates are high now, hold on to your car seats. But you're not in the car seat, hold on to your something. They were approaching 12 to 14%, peaking in the early 80s. Ouch. Why? Inflation crushed the bond markets, kind of like they did in the last couple years there, right? Inflation went crazy. The Fed eventually had to raise rates aggressively to stop it. Does that sound familiar? We're going to raise rates 75 basis points. Psych, we're going to raise them 500 basis points, which we just went through after the pandemic. So some of you now, we're like my age, you'll remember the Gulf War from 1990 to 1991. And remember, the Vietnam War was 60s and 70s. That thing went on for a long time. In the Gulf War from 1990 to 1991, the 10-year Treasury yield fell from 8.5 to 7.5. Mortgage rates dropped from 10 to 9%. Why? Global fears over oil and conflict, flight to safety and bonds, yields fall, mortgage rates fall up. Now we've got the Iraq War. In 2003, treasuries rally, yields fell from 4.2 to 3.1%. Wow, that's a pretty significant drop. In mid-2000, mortgage rates dropped around 5.25%, the lowest at all time in decades. The last time it was probably that low was up in the 1940s. And then why did rates drop? Why? Uncertainty, fear, and slow economic growth after the dot-com bust. Ooh, remember that? Dot-com bust, and then boom, went to Iraq War. So what do? You drop interest rates to stimulate things. 2022, can you guys name the war? Oh, the Russia-Ukraine war. So fun. Initial reaction, bond yields fell, flight to safety, right? Then Energy and food inflation hit hard. Remember that? Ouch. Hit hard. But guys, inflation was already rearing its head in 2021. But as you guys know, inflation took off. It was not because of this war. It's because of all the money printing from both sides of the aisle for COVID, and just kept going and going and going. Then energy, food hit hard. Bond yield spiked. Mortgage rates surged from 3% to over 7%. Wowzers. Why? War plus supply shock plus existing inflation equals massive Fed tightening. And guys, we're still living through that right now. Let's be honest. The Fed has not really moved much. The pattern: war equals fear equals bond rally equals lower rates at first. But if the war fuels inflation, especially via commodities, it eventually sends rates higher. Here we are in 2025. I'm not calling it war. Some people call it war. I don't know what it is, but regardless, I'm just here to talk about data so you can kind of see. Everybody's like, when we hit war, typically rates went down, right? Typically. So that's what happened. The 1970s, inflation was out of control, and so they had to stop it. But as you can see, war equals maybe uncertainty equals slowdown equals lower rates. Why is 2025 different? This year has been a roller coaster already, and we have not even gotten through summer. I'm going to read some of these headlines. We've got sticky inflation, especially in rents and services. Just so you guys know, I always talk about this on this channel. Rent is starting to come down. You are going to start to see from June until the end of this year, you will start seeing rents. That number in PC and CPI, PC, by the way, is out this Friday. You will start seeing rents to show up and bring inflation down further, because remember, the Feds with inflation, it's rolling data over years. They're not looking at current data, because if they're looking at the current rent data and they put it in their model, right, inflation would be lower than it is now. And my guess is they would probably be cutting. They know that. We know that. Now you know that, but they don't do squat about that now. Massive refinancing needs. The U.S. government has over $8 trillion. It's actually $9 trillion, I believe, in treasuries but maturing that need to be reissued. That's why Trump is on there saying, get these rates down. We'd love to refinance that debt. And maybe instead of 4.5, maybe 3.85, 3.5, we'd save hundreds of billions of dollars in interest on $9 trillion. Do the math. If you lower it 1 point, it's crazy. The new tax bill, a big, beautiful bill, that needs lower rates to make the math work. Tariffs, raising the cost of goods. We got that. We don't know if it is. It supposedly is. We're waiting to hear. It hasn't showed up to inflation. Housing market inventory climbing, but without panic crash. That is true. Inventory is climbing. We are not near 2008 levels, not even close. We're starting to approach pre-pandemic levels in some cities, but like here in San Diego, we are not. I'll give you an example, just so you guys know. In San Diego in 2005, 6, 7, we had over 20,000 listings. Let me repeat, 20,000 listings at this moment. It would be like in summer. Currently right now we have about 4,000 listings, and I use that taking pending out. So again, let me repeat, we had 20,000 listings pre-crash. Now we have 4,000. That's just San Diego. There's other cities that might be catching up. I'm not talking crash. I'm just talking pandemic. We're not even at pandemic. At pandemic levels, meaning normal for San Diego in the summertime, we anywhere hit from 10 to 15,000 listings. We're still not there either. Moving on. And the Fed is still trying to thread the needle between inflation and a slowing job market. Add war with Iran to that. Are we going to war? I don't know. It's not a clean formula. If the U.S. goes to war with Iran, what could happen? Short-term interest rates could fall. People could go panic instead of going into stocks and things like that, because they could have sell-offs and uncertainty. Maybe there's a flight to treasuries. Maybe there is. I don't know. That could help out. They're also going to try to pass this big, beautiful bill before July 4th. That could help rates as well, because there's some things in there that are going to help banks and things like that put money into treasuries. Obviously, if we have a conflict with Iran, our oil prices are going to spike. They kind of already have. That's more inflation on the consumer. That's not good for lower interest rates. More inflation pressure obviously keeps the Fed more hawkish, and they're going to keep that. That could neutralize any drop to interest rates. Long term, it's going to be a battle between fear and inflation, but obviously right now the Feds they're focused on inflation, they're focused on tariffs, but they're also not overly concerned with inflation because it is going lower at this moment. They're not overly concerned about the overall economy because they feel like it's doing well. They're not overly concerned about the jobs market because it's still you got low unemployment, they're starting to see some cracks in the economy, some cracks in the employment, and obviously inflation is actually lower than they thought, but they're concerned that tariffs might bring that back. So if war does cause a recession, which sometimes does, that would be like uncertainty where people are going to spend less money or do more things. That would then hurt the job market. If the job market is hurt, I'm telling you right now, the feds will cut right away. If inflation flares up, tariffs or energy costs, they might hold rates, or they could even raise rates, as crazy as that sounds. So where are we at real quick? I just want to jump in here. Where are we at with the housing market? I just want to give you a quick temperature reading on the housing market so you kind of have an update of where we're at. So in 2025, as I shoot this video, June 23rd at 9:45 a.m., I'm looking up there. Here we go. Inventory is up 33% year over year. So it's not crashing, but it's definitely rising, and we're coming off low inventory. 40% of the homes have price cuts. That's up from 37%. That's nationwide, but places like here in San Diego, we're only seeing 20 to 25%. New listings are solid, but not flooding the market. During the housing crash years, you ready? From 2007 to 2010, hang on to your seats. We were seeing 250,000 to 400,000 listings hit the market. Are you ready? Per month? Nope. Per quarter? Nope. Per year? Nope. Per week? Yep. And right now we're seeing around 75 to 90,000 listings per week hit the market. So when people tell you it's going to crash, I'm just trying to tell you, this is a huge number. 250,000 to 400,000 listings per week. That is one thing that you look at to see how the real estate market's doing. If you see 75 to 90,000, we're actually about 80,000. We've hit 80,000 3 times this year so far. If you start seeing that go 100, 150, start spike, you know we could have a real estate problem. With unemployment, when every Thursday we get out the, unemployed claims or people that are, fell out, that number is starting to move up a little bit. We're around 200,000. Now it's over 243. That number, if that got up to 300,000 or plus 4 weeks in a row, that would start to send, the feds would start having palpitations, and they would start changing their message and clearly start, and maybe even cut rates faster and more dramatic. So 2 things with housing, look at the weekly inventory. With unemployment, every Thursday, you get the initial jobless claims. That number, you want to go over 300,000. That hits there for 4 weeks, over 300,000. You would start seeing a change in the tone of Fed, because that would probably mean you have unemployment going higher, a job market starting, instead of cracking, starting to show glaring signs of issues, and you would start to see a different tone in the Fed immediately. Trust me on that one. Even with inflation doing stuff, they would start to definitely take a look at that. Buyers are cautious. There's no panic. If war dips rates, we can see more buyers jump in, but unless then they feel confident, inflation won't get worse. So here's the deal. Look, we don't know if we're going to war. We don't know what we're doing. Nobody knows anything. You don't know if rates are going higher or lower. We don't know what's going to happen with inflation. This week, we do have PCE out. Next week, we have the unemployment numbers. So 2 big weeks coming up. But not to mention, look, there are people that are out there buying with these high rates, but they're also negotiating good deals, good prices while things are sitting on the market. So if you are a buyer and you're looking to buy, it's actually a great time. Just make sure you have a good team, a good loan officer, a good realtor that can get you in a good deal. And, whether you're having that agent, having that seller pay for your closing costs, pay for the buy down the rate, or you're just getting a good deal on the house and you're going to settle a certain interest rate, it's all good. Just make sure you're working with a really good team that has your best interest in hand. That's all I'll tell you, whether you're buying a primary, investment home, whatever it is. Teamwork makes the dream work. But as far as the data, we'll continue to watch. I can tell you right now, if PC comes in lighter than expected this week, expect a lot of pressure just from himself on Jerome Powell to be like, oh my gosh, do I need to cut? Inflation is not showing signs of increasing with the tariffs, but if PC comes in lower, expect a lot of people all over to start really sounding the alarm on why the Mr. Jerome Powell is not cutting rates and how he should be in July. So we will have inflation, a jobs report, but I hope you found this video interesting. Like I said, if you have any questions, reach out to me anytime, no problem. Love to chat about real estate, love to answer your questions. You got a refi, purchase, whatever it is, we're always here. We love to help everybody, whether you're a veteran, you have an FHA mortgage, you're conventional, a jumbo, you're self-employed, you're a real estate investor. We do it all here. And like I mentioned before, it's not just me, it's a team But I hope you found this interesting. There's a lot of cool stuff in here, and I hope we don't go to war. And I hope inflation doesn't spike out of control. And I hope that the Fed starts to see that the data is in line and starts cutting rates, because it'd be really nice to have a 30-year fixed on a conventional mortgage with good credit. And we could get you maybe in the mid fives with no points, and then buying it down could be in the low fives. And FHA, VA, government loans would be in the fours. And commercial and residential rates would be in the 5s and 4s, and then we could refinance our debt much cheaper. I would love that. Yes, maybe I'm a little biased because I'm in real estate, but I can tell you right now, the data shows that we should be cutting, and if it wasn't for the tariffs, they would have already cut. But we are here. That's what I got for you. Thanks for watching. We'll be in touch soon.